There are moments in markets when the surface no longer seems to make sense. Inflation is still a problem. Oil is rising. Rate cuts are being pushed further away. Consumers feel worse. Housing is softening in many places. The Federal Reserve is warning that it cannot relax too quickly, and yet the stock market is pushing back toward all-time highs, as if none of this matters. That is the kind of market that humbles people. It humbles pessimists because prices rise when the news looks bad. It humbles optimists because the rise can become so fast and emotional that it begins to look like the final stage of a cycle. It humbles traders because 10 days can erase months of fear. And it humbles investors because it reminds them that the market is not a machine designed to make emotional sense to human beings. The market is a discounting machine. It does not care how you feel today. It is always trying to price what it thinks tomorrow will look like. Sometimes it gets that wrong, sometimes it gets it very wrong. But the key is that Wall Street and Main Street can live in completely different emotional worlds at the same time. That is what we are seeing now. Main Street is looking at grocery prices, oil prices, mortgage rates, job security, rent insurance, and the cost of everyday life. Wall Street is looking at future earnings, liquidity, policy expectations, corporate margins, technological growth, asset flows, and whether the next 12 months might look better than today feels. That gap can become enormous. And when that gap becomes enormous, many people assume something must be broken. Sometimes something is broken. Sometimes the market is simply moving before people feel better. That is why this environment is so dangerous for emotional decision making. If you are waiting for everything to feel clear before investing, the market may already have moved. If you are buying only because prices are rising, you may be stepping into risk after the easy part of the move has happened. The truth is that both can be true. The market can be in a melt-up, and the economy can still have real problems. Those two realities are not contradictions. They are the kind of contradiction that often appears late in a cycle. A melt-up is not the same as a healthy advance. A healthy advance is usually supported by broad participation, improving fundamentals, stable inflation, manageable debt, and confidence that is grounded in real cash flows. A melt-up is different. A melt-up is when prices rise because investors are afraid of being left behind. Liquidity moves, momentum builds, short sellers cover. People who sold the bottom panic back in. Index buyers keep buying. Algorithms chase strength. Cash on the sidelines feels pressure. Then the market rises not only because fundamentals are improving, but because positioning and psychology are forced to adjust. That can be powerful. It can last longer than people expect. It can make cautious investors feel foolish. And then, if it becomes disconnected enough from reality, it can end violently. That is why the phrase melt-up matters. It is the mirror image of a panic. In a panic, people sell because prices are falling. In a melt-up, people buy because prices are rising. Both are emotional. Both can become self-reinforcing. Both can take prices farther than rational analysis would suggest. And both eventually have to meet the underlying machine. The first pressure in that machine right now is inflation. More specifically, oil. Oil is not just something you put in a car. Oil sits underneath the entire cost structure of the modern economy. It moves goods, it powers ships, trucks, planes, tractors, factories, plastics, packaging, fertilizer, and a large part of the supply chain. When oil rises, it does not stay in one corner of the economy. It moves into transportation, it moves into food, it moves into shipping, it moves into manufacturing, it moves into packaging, it moves into profit margins, it moves into inflation expectations. That is why a sharp increase in crude prices can change the Federal Reserve's problem very quickly. If oil rises from the 50s to around $100, the inflation picture changes. It can add pressure to headline inflation, and it can also affect consumer psychology. People see gasoline prices directly, they feel it quickly. They may not understand the full supply chain, but they understand the pump. Oil inflation is politically and psychologically powerful. It makes people feel poorer. It can reduce discretionary spending. It can compress margins for companies that cannot pass costs through. It can make bond investors demand higher compensation. It can keep mortgage rates elevated, and it can make the Federal Reserve less willing to cut interest rates. This is why the rate cut story changed. Markets wanted cuts, investors wanted cheaper money, borrowers wanted relief, home buyers wanted lower mortgage rates, companies wanted easier financing. But if inflation is still too high and oil is pushing costs higher again, the Fed cannot simply declare victory. That is the trap. If the Fed cuts too soon, inflation may reaccelerate. If the Fed stays tight too long, growth may weaken. If oil remains high, the Fed faces the worst kind of problem, inflation pressure. At the same time that parts of the economy are fragile, That is why rate cuts being delayed matters. It is not only a headline, it affects the entire pricing of risk. When rate cuts are expected soon, investors can justify higher valuations because future money is expected to be cheaper. Mortgage borrowers can hope for relief. Companies can refinance more easily. Housing can find more support. Speculative assets can recover. When rate cuts are pushed out, the environment is less forgiving, yet the market is still rising. That is the central tension. Why would stocks rally so strongly if the Fed is not cutting? Because markets do not move only on one variable. They move on relative expectations, positioning, liquidity, earnings, sentiment, and the possibility that the future will be less bad than feared. If investors were positioned too defensively and the market does not collapse, the reversal can be violent. If people sold because they expected a recession and the recession does not arrive immediately, they may have to buy back. If companies continue reporting earnings that are better than feared, the market may reprice higher. If cash on the sidelines becomes impatient, it can chase. If algorithms and momentum funds detect strength, they can amplify the move. This is why the market can rally even while the macro picture remains messy. The market does not need everything to be good. Sometimes it only needs things to be less bad than the positioning assumed. That is why people who sold at the bottom waiting for clarity missed the rally. Clarity usually comes late. The best prices often arrive when things look most uncertain. That is not because uncertainty is pleasant. It is because uncertainty is when fear is high and sellers are forced. If you wait until the news feels safe, the price often reflects that safety already. This is one of the hardest lessons in investing. The moment that feels safest is often not the moment with the best future return, and the moment that feels most dangerous is often where future returns are being created. That does not mean you buy every decline blindly. It means you do not confuse your emotional comfort with investment opportunity. Now, let us look at the stock market behavior itself. A 10% rally in roughly 10 days is not normal. Moving from oversold to overbought in a very short time is not normal. A long NASDAQ win streak is not normal. These are signs of force. They show that capital was underpositioned, that fear was too high, or that momentum became self-reinforcing. But force does not automatically mean durability. A violent rally can be the start of a new leg higher. It can also be a bear market rally. It can be a melt-up before a breakdown. It can be a repricing of future growth. It can be all of those things at different stages. This is why prediction becomes dangerous. Most people want the market to give them a simple label: bull market, bear market, bubble, crash, recovery, melt-up. But the market does not live inside our labels. It moves through forces, liquidity, earnings, rates, inflation, positioning, psychology, policy, credit. When those forces point in different directions, the market becomes confusing. That confusion is exactly why many people should not try to time it. The source makes a very important point. People who sold in April waiting for clarity missed one of the fastest rallies in history. That is not an accident. It is the normal punishment for demanding certainty. Markets often move before the explanation is widely accepted. By the time you feel that the coast is clear, the market may already have repriced the clearing. That is why long-term investing works better for most people than tactical prediction. Not because long-term investing is exciting, because it removes the need to be right about the next 10 days. Most people cannot consistently predict the next 10 days. They cannot predict the next Fed statement, the next oil move, the next geopolitical shock, the next earnings surprise, the next tweet, or the next liquidity event. Even if they analyze the data correctly, one new piece of information can change the entire path. That is the problem with trying to be clever. You may be right on the data and still wrong on the market, because markets are not only data, they are expectations about data. They are expectations about the reaction to data. They are expectations about how other people are positioned in relation to the reaction to the data. That is a very complex machine. Most investors should not try to outthink it every week. They should design a system that survives it. That brings us to consumer sentiment. Consumer sentiment is extremely weak, yet the stock market is strong. This looks bizarre until you realize that they are measuring different worlds. Consumer sentiment asks how people feel about life right now. Can they afford groceries? Can they afford gas? Can they buy a home? Do they feel secure at work? Are prices rising faster than pay? Do they feel better or worse than last year? The stock market asks a different question. What will corporate earnings look like in 12 months? Will policy become easier later? Will trade tensions resolve? Will growth surprise? Will AI continue to drive capital spending? Will margins hold? Will liquidity return? Those are different questions. A person can feel terrible today while investors buy stocks because they believe tomorrow's earnings will be better. That does not mean the person is wrong. It means the time horizon is different. Main Street lives the current cost. Wall Street prices the future expectation. When sentiment is very low, it can sometimes become a contrarian signal. If everyone feels terrible, a lot of bad news may already be reflected in behavior and positioning. When sentiment begins to recover, stocks may continue rising. But this is not a law. Low sentiment can also reflect real pain. A serious investor must ask whether sentiment is low because people are emotionally too pessimistic or because the underlying pressure is real and still worsening. Sometimes both are true. That is why the current market feels unstable. Asset prices are saying one thing, household reality is saying another. When the gap becomes too wide, either the economy improves enough to justify prices or prices eventually adjust to the economy. Nobody knows exactly when or how that adjustment happens. That is why risk management matters. Now, Bitcoin adds another layer. Bitcoin often behaves like a liquidity-sensitive, risk-seeking alternative store of value asset. When investors expect easier money or when they are looking for alternatives to fiat currency and government debt, Bitcoin can attract capital. Institutional ETF flows matter because they create a simpler way for large investors to gain exposure. The presence of large financial institutions around crypto also changes the perception of the asset class. In the Source S framework, Bitcoin is rising again while the SP is also strong. That fits a melt-up psychology. Risk appetite returns. People who doubted the asset at lower prices begin to chase. People who bought when the account was red feel validated. Institutional flows reinforce confidence. The national debt continues rising, which strengthens the narrative that some investors need alternative stores of value. But Bitcoin remains volatile. It can fall 30% quickly. It can rise 25% quickly. It can make people feel brilliant or foolish depending on the month. That is why position sizing matters. A person who keeps Bitcoin under a defined percentage of the portfolio can participate without allowing it to dominate their financial life. A person who goes all in is no longer investing in an asset class. They are letting one volatile thesis control their future. There is a big difference. The source says something important about doing the opposite of the general market belief when everyone says Bitcoin is dead. That has often been closer to opportunity than danger. When everyone says Bitcoin is going to $1 million immediately, that may be closer to danger than opportunity. This is not only about Bitcoin, it is about sentiment extremes. When everyone believes the same thing, ask who is left to buy or sell. If everyone is bearish, the marginal surprise can be positive. If everyone is euphoric, the marginal surprise can be negative. That is a principle. Markets move on surprises relative to expectations. So Bitcoin may have a role for some investors as a volatile alternative asset. But the key is humility. It can work. It can also punish overconfidence. The correct approach is not blind belief or blind dismissal. It is sizing, time horizon, and clarity about risk. Now, housing is very different. Housing is not behaving like a broad melt-up asset in the same way. National prices may still be positive year over year, but forecasts are being revised down in many places. Some institutions expect flat prices, some expect modest increases, some markets are softening, especially in areas that had enormous run-ups during the pandemic period. That makes sense. Housing is highly sensitive to affordability. Affordability is driven by home prices, mortgage rates, income, insurance, taxes, and supply. If prices rose sharply and mortgage rates remain high, many buyers are simply priced out. Lower rates would help, but not as much as people think. If rates fall only modestly, a drop from very high mortgage rates to something like the high fives may improve purchasing power. But it may not suddenly make an unaffordable market affordable. That is the problem. People keep waiting for one variable to fix the whole system, but housing affordability has multiple variables: prices, rates, income, inventory, insurance, taxes, maintenance, location. If prices remain high and rates only fall a little, affordability may remain poor. That is why certain markets can soften. Sellers who bought near peak prices may take losses if they need to sell. Inventory can rise, buyers can become patient, negotiation returns. The sense of urgency disappears. This creates regional divergence. Some Sunday belt markets that rose aggressively may struggle as inventory grows and affordability breaks. Some northern or more affordable markets may hold up better because price levels are more reachable. The West Coast may be flat in some forecasts because prices are already high and affordability is stretched. This is important because housing is not one market. It is thousands of local markets. A national average can hide enormous differences. In some places, prices can fall. In others, they can rise. In others, they can stagnate for years while inflation slowly adjusts real values for investors and homebuyers. The lesson is not to rely on headlines. The question is local supply, local affordability, local job growth, local taxes, local insurance costs, and your own time horizon. If you are buying a home to live in for 10 or 20 years, the decision is different from buying because you think rates will fall next quarter. If you are buying with no margin of safety, hoping that refinancing will save you, you are vulnerable. If you are waiting for a perfect crash in a strong local market, you may wait forever. Again, the answer is not prediction, it is resilience. Do not buy what you cannot carry. Do not assume rates will fall enough to rescue the math. Do not treat national forecasts as local truth. Do not confuse a house with a short-term trade if your life depends on it. Now, the Federal Reserve leadership question introduces another emotional layer. The source suggests Jerome Powell's term is ending and that a new chair may take over with the possibility of a different policy direction. Whether one specific person is more hawkish or dovish matters, but not as much as people think. The Federal Reserve is not one man, it is a committee, it is an institution. It operates inside the constraints of inflation, employment, financial stability, government debt, market expectations, political pressure, and credibility. A chair matters because communication matters, leadership matters, the reaction function matters, but no chair can permanently ignore inflation, bond markets, currency, credibility, and financial conditions. If a new Fed chair wants lower rates but inflation is rising because oil is rising, the system constrains that decision. If a new Fed chair wants to shrink the balance sheet but markets become unstable, the system constrains that decision. This is why investors should not reduce everything to personalities. Personalities matter at the margin. Systems matter more. The system right now is caught between inflation pressure and debt pressure. It wants lower rates because lower rates help borrowers, housing, asset prices, government interest costs, and financial conditions, but it cannot cut too easily if inflation is not under control. That is the core tension. A new chair may change the tone, the tension remains. The source mentions that markets have historically seen weakness after new Fed chairs take office. That may be interesting, but historical averages should not be treated as destiny. Context matters, valuation matters, inflation matters, policy matters, positioning matters. The right conclusion is not to sell everything because a new chair arrives. The right conclusion is that leadership transitions add uncertainty, and uncertainty should be managed through allocation, not emotional prediction. Now, what is the practical lesson from all of this? The source's conclusion is straightforward. Do not try to time the market. Decide how much you can invest consistently. Choose an allocation you can hold through large drawdowns and continue investing. That may sound simple. It is simple, but it is not easy. The reason it works for many people is that it accepts a hard truth. You do not know the short term. You do not know what oil will do next month. You do not know when the Fed will cut. You do not know whether the next rally is a melt-up or the start of a durable bull market. You do not know whether Bitcoin will fall again before rising. You do not know whether housing will soften more or stabilize. You do not know whether consumer sentiment will recover or break lower. You do not know whether a black swan will arrive. You do not know. Most investors pretend they know because uncertainty is uncomfortable, but pretending creates bad decisions. A better approach is to build a system around not knowing. That means a fixed investment plan, a diversified allocation, enough cash for emergencies, no leverage that can force you out, position sizes you can emotionally survive, long-term ownership of productive assets, a willingness to keep buying when headlines look bad, a refusal to chase with money you cannot afford to lose. That is the strategy that prevents every headline from controlling your behavior. A person who has no system is pushed around by every Fed meeting, every oil move, every inflation print, every housing forecast, and every Bitcoin swing. A person with a system reads the information, updates the probabilities, but does not abandon the plan every time the market makes a large move. That is the difference between investing and reacting. Now, this does not mean you never adjust. Markets change, valuations change, life circumstances change, risk tolerance changes. If your allocation no longer fits your goals, you should adjust rationally. But adjusting is different from panicking. Adjusting is based on a plan. Panicking is based on emotion. The source gives a very practical idea. Choose an allocation you can live with through a 30 to 50% drawdown. That is crucial. If you cannot emotionally survive a 50% decline in a risky asset, do not build a portfolio that requires you to survive it. You will sell at the worst moment. The best allocation is not the one that looks optimal in a spreadsheet. It is the one you can actually hold. Behavior is part of the return. A brilliant portfolio abandoned during a crash is not brilliant. A simple portfolio held for decades can outperform a complex portfolio traded emotionally. This is why consistency matters. If you invest a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high, you remove the emotional pressure of choosing the perfect moment, you participate in the long-term growth of productive assets without needing to predict every cycle turn, that is dollar cost averaging. It will not give you the perfect bottom. It will not make you look like a genius at cocktail parties. It will not protect you from drawdowns, but it can keep you in the game. And staying in the game is one of the most underrated advantages in investing. Most people lose not because they choose a bad asset class, but because they cannot tolerate the path. They sell when fear peaks, they buy when euphoria peaks, they hold cash waiting for clarity, they chase after the rally. They treat every market move as a referendum on their intelligence. That behavior is expensive. A consistent system protects you from yourself. Now, let us return to the melt-up idea. If we are in a melt-up, the market can go higher than reason suggests. People who are underinvested can feel increasing pressure. The more it rises, the more they feel wrong. That can create forced buying. The market can become reflexive. Higher prices create more demand, which creates higher prices. But the danger is that a melt-up can create fragile confidence. Everyone feels rich because asset prices are up. But if the underlying economy remains stressed, the wealth effect may not be evenly distributed. Asset owners feel better. Wage earners still face inflation. Home buyers remain priced out. Renters feel pressure. Consumers feel weak. Debt costs remain high. This divide can persist for a while, but eventually asset prices and real economic conditions must reconcile. Either earnings and growth improve enough to support the prices, or prices become vulnerable. That does not mean sell everything. It means do not confuse rising prices with the absence of risk. Markets near all-time highs can still be attractive over long periods if earnings grow. They can also be expensive if expectations are unrealistic. The correct response is not emotional. It is disciplined. Keep investing according to plan. Rebalance if the portfolio has become too risky. Do not chase with borrowed money. Do not abandon cash reserves. Do not sell everything because the market looks high. Do not believe every rally is permanent. Do not believe every warning means collapse. Hold the tension. That is what mature investors do. They can say the market is strong and the risks are real. They can say oil inflation matters and stocks may still rise. They can say Fed cuts being delayed matters and long-term investing still works. They can say Bitcoin is volatile and may still have a role. They can say housing is local and affordability is strained. They can say the future is unknowable and still make a plan. The ability to hold multiple truths at once is one of the most important investing skills. Beginners want one truth. Everything is bullish. Everything is bearish. The Fed controls everything. Oil controls everything. Bitcoin is dead. Bitcoin is going to 1 million. Housing only goes up. Housing is about to crash everywhere. Those are simple stories. Simple stories feel good because they reduce anxiety, but markets do not reward simplified certainty. They reward accurate adaptation to complex systems. This market is complex, so the plan must be robust. Now, how do you use this information to come out ahead? First, recognize that oil matters for inflation and policy. If oil remains elevated, do not assume rate cuts are guaranteed just because investors want them. Second, recognize that stocks can rally even in bad macro conditions. Do not wait for emotional clarity before investing, if your time horizon is long. Third, recognize that consumer sentiment and stock prices can diverge because they measure different realities. Do not use your personal frustration with prices as the only guide to asset allocation. Fourth, recognize that Bitcoin and other risk assets are highly sentiment-driven. Size them so volatility does not control your life. Fifth, recognize that housing is local. Do not use a national forecast to make a personal purchase decision without analyzing your market and your financial strength. Sixth, recognize that Fed leadership changes are important but not omnipotent. The system's inflation and debt constraints matter more than one person's statements. Seventh, recognize that consistency beats cleverness. For most investors, this is the practical framework, not prediction, preparation. The market may keep melting up, it may reverse. Oil may push inflation higher, it may fall. The Fed may delay cuts, it may be forced to cut later. Bitcoin may continue higher, it may drop hard again. Housing may soften nationally, some markets may still rise. A new Fed chair may change the tone, the institution may remain constrained. You cannot know all of it in advance, but you can know how you will behave. That is where control exists. You do not control Jerome Powell, you do not control oil. You do not control the NASDAQ. You do not control Bitcoin. You do not control mortgage rates. You do not control consumer sentiment. You control your savings rate, your allocation, your cash buffer, your debt, your diversification, your risk level, and your consistency. That is enough. Most people lose because they focus on what they cannot control and neglect what they can. Do not do that. If you have an emergency fund, you can survive volatility better. If you have no high interest debt, inflation and rates hurt less. If you invest consistently, you do not need perfect timing. If you diversify, one wrong prediction does not destroy you. If you size risky assets properly, you can hold them through drawdowns. If you understand that markets move before emotions recover, you do not panic because you feel bad while prices rise. That is how you behave rationally in an irrational-looking market. Now, let us be honest about the final phase of a cycle. Sometimes everyone feels rich before the bill comes due. Asset prices rise, home equity rises, Bitcoin rises, stocks rise, people become confident, they borrow, they spend, they extrapolate, then rates, inflation, earnings, debt, or liquidity eventually force a reset. That pattern has happened many times. But the existence of a potential future reset does not tell you when to exit today. This is the difficulty. A late cycle melt-up can create huge gains before it ends. People who exit too early may miss the move. People who enter too late may absorb the collapse. The answer is not to guess the perfect exit. The answer is to maintain an allocation where you do not need perfection. Take appropriate risk. Rebalance when risk becomes too concentrated. Keep a plan. Avoid leverage. Invest steadily. Accept that you will not catch every top or bottom. That is a sane way to operate in an insane-looking market. It may feel boring. Boring is often what works. The market tries to seduce you into drama. It wants you to think every meeting, every headline, every rally, every crash, every oil spike, and every Bitcoin move requires a new identity: bull, bear, trader, contrarian, maximalist, doomer, optimist. You do not need those identities. You need principles. A principle says, I will not sell long-term productive assets because fear is high. A principle says, I will not chase a vertical rally with money. I cannot afford to lose. A principle says, I will keep investing regularly. A principle says, I will hold enough cash to avoid forced selling. A principle says, I will size speculative assets modestly. A principle says, I will think in real purchasing power. A principle says, I will not confuse Main Street pain with immediate market direction. A principle says, I will not confuse Wall Street strength with the absence of risk. That is how you navigate, not by knowing the future, by having principles that work when the future is unclear. This market may be one of the strongest and strangest markets we have seen. It may be the start of a broader advance. It may be a melt-up before a correction. It may be both, depending on the time horizon. Oil may keep inflation sticky. The Fed may stay on hold longer than investors wanted. Consumers may remain unhappy. Housing may remain uneven. Bitcoin may continue behaving like a high volatility hedge and risk asset at the same time. Stocks may continue to climb because the market sees a future that households do not feel yet. All of that can be true. The investor's job is not to eliminate uncertainty. The investor's job is to build a life and portfolio that can survive it. If you are young, time is your advantage. Keep investing. If you are near retirement, risk control matters more. Do not let a melt-up push you into a portfolio you cannot survive. If you own a home, understand your local market and your debt. If you want to buy a home, do not rely on rate cuts alone to save affordability. If you hold Bitcoin, understand volatility and size it accordingly. If you hold cash, understand that inflation can erode it. If you hold stocks, understand that drawdowns are part of the price of long-term returns. This is not complicated. It is difficult because emotion interferes. The market will always give you reasons to stop. High inflation, no rate cuts, oil shocks, political changes, Fed transitions, weak consumers, housing uncertainty, crypto volatility. It will also give you reasons to chase all-time highs, fast rallies, Bitcoin rebounds, home prices rising, media excitement, friends making money. Both fear and greed will sound intelligent when they speak. You need a system louder than both. That system is the final answer. Decide what you can invest. Decide what allocation fits your life. Expect large drawdowns. Avoid leverage. Stay diversified. Keep adding rebalance when necessary. Ignore the need to be clever because the market can move from panic to euphoria in 10 days. And the person who tries to emotionally interpret every move will usually be late to both. The person with a system may not look brilliant every week, but over many years, the system has the best chance of doing what matters: keeping you invested, keeping you solvent, keeping you calm, and allowing compounding to work while everyone else is trying to predict the next headline. That is how you come out ahead in a market that does not make sense. You stop demanding that it makes sense every day. You understand the forces, you respect the risks, you keep investing with discipline, and you let time, diversification, and productive assets do the work that prediction usually fails to do.